Hey everyone, this is 𝙁𝙁𝙀𝙀𝙎, your host with the Freedom Report for this week's precious metals presentation. Now I've broken out precious metals into its own video like we used to have on the channel. The rest of the weekly market report is going to get broken out into different segments. Two reasons for that. People are watching shorter form content, don't like long videos as much, so we're going to accommodate that. That has been the trend in social media for a very long time. Secondly, I believe that while doing the economic and gold reports together and covering a little bit of the news made sense back then, I think we're shifting into a different era in America where things are getting a little bit more crazy. As I said, 2024 be the year of volatility. And I didn't just mean economically. I meant socially, politically, culturally, and everything else as well. And I think now those segments of our report deserve their own videos. So in addition to shortening our overall length of video to keep viewers on the channel as well, we're going to have more separate reports to cover those different areas. And that's why I rebranded the channel to the Freedom Report. That change was coming all along. And I think now that we're officially getting into fall here in the next couple of weeks, now is a good time to make the change. Now, volatility is up everywhere, and we'll be covering that as we go through the rest of the year. But we're going to dive right into the gold and silver report, which we're going to focus on. I got a lot of charts for you from the World Gold Council. I've got some research on silver in India, as well as new silver battery technology, which is very exciting, going to lead to an increase in demand. And I think things are really looking up for gold and silver going forward. And we're just going to jump right in the presentation and show you what we got there. Up on screen, we're going to do the typical gold futures off of the CME Group's website. You can see here about average volume that we're looking at dating back a month and a half ago. It was actually a little bit more frothy at the end of July, beginning of August. A lot of times August can be a big month for gold. It's hit or miss. Sometimes gold does really well in August. Sometimes it fades. I predicted maybe a bit of a fade. And actually what we did, by the time you look at the numbers for August, it just basically range traded. It was up over the month, but there wasn't a significant pullback, but it wasn't a huge surge either. So we'll get into that. Getting into the data overall, at as of Friday, we had 516,479 contracts trading. You can see top line, we did have 2,643 deliveries, and I'll get in deeper into the deliveries on gold here in a minute when we look at the NYMEX delivery report, which I should have up here, which we'll get to. Also, as you can tell, looking at my the browser bar at the top, I've got a lot more in gold. So this would be primarily gold with some silver built in, because there's been a lot of stuff going on with gold, and I have a lot of data for you. Notice how the clear ports and the block trades, the EFPs, and the TASs are all elevated. We'll start with the EFPs first, because you may be more familiar with those from watching my program or other programs. That's exchange for physical, and that's where you take a position on the COMEX and go over to the UK market and hunt for the gold, or maybe look for price differences. I'll show you in a minute why COMEX really determines world gold price right now in a chart from the World Gold Council. But suffice it to say, people come into the COMEX and then try to take their trade somewhere else if they're not getting either the price or the liquidity of the actual physical that they're looking for. The fact that the EFPs are at 51.61 at the end of the day signifies strong demand for gold and a stronger bullish price for gold as well at the same time. The Clearport, I'll read to you what the Clearport is. It's an acronym for privately negotiated trades, which may be reported through Clearport, the CME Group's clearing service for over-the-counter markets, or directly into CME clearing. So that could be an over-the-counter market in, or it could be an over-the-counter trade here on this market, and that is elevated, meaning the over-the-counter trades, privately negotiated type of trades, are up. Block trades, that is essentially where two parties agree, or multiple parties can agree to trading blocks of contracts at one time and bring it onto the exchange once the trade's been agreed, is up. A lot of that's to avoid price volatility. Gold has had a lot of price volatility this year. It's in the World Gold Council trading data. It's had actually more volatility than some of the stock markets around the world. So there's a lot of volatility in gold going on because of this war of the short and the longs, which I talk about every week. And that's why the increase in block trades. If we look at trade after settlement is an order type that specifies the day settlement price as the order price. So they take a set price, they do a trade at settlement, and that's put on the market, again, avoiding price volatility. Why? Because prices are volatile for gold on the exchange. You can see that the dominant month is still December, although we start to see trades heating up for February as well. So we got 23,000 contracts, and for April, 17,302. But definitely December is the big one. October still has a few trades here and there. September had some nice deliveries there on Friday. We'll go over the delivery report in a moment. Settlements, the only reason I look at that is to tell you this is where the price is determined. So the settlement price is the average of all the trades and the average gold price, which is what spot essentially is, at least in the American market. And that's what determines the prices you pay when you go online to order the physical, or you trade it with a friend, or you go to your local coin dealer. And then 99.5% of trades on a typical day are not physical deliveries. It's just paper rotated around. You can tell that if we go back to the volume in OI, and we look at the fact that we had 516,000 open interest, open contracts, a total closed volume of 189,000, and only 2,643 deliveries. So 2,600 of these 189,000 were delivered in physical. You know, the vast majority of that is simply paper trading, hunting around for price differences to scalp, basically, or to make money, you know, on that trade in a short-term basis. Here, you get the change in price listed. So that's Friday's change in price was down about 30 bucks. Thursday was up about 22 bucks. Wednesday was down about 15 bucks. A lot of range trading you can see in gold. It goes up, it goes down, it goes up, it goes down. And it's stuck in a band somewhere between 23 and 2,500 essentially for most of the last 6 weeks or so. Moving on to some data we have for gold from the World Gold Council, as you can see on their website, World Gold Council. Futures positioning, open interest has definitely been up all year long. As you look, there's been a lot of interest in gold overall, and I've been talking about that. I've been talking about how specifically in the summer, how the open interest has been very high. Here's the summer this year, here's the summer last year, and here's the summer the year before. You saw that in 2022, open interest came down as it typically does in the summer. 2023, open interest came down until the fall. This time, open interest went up in the summer. So the overall interest in the COMEX specifically and in overall markets went up. We saw it in Shanghai as well. You can see in the light pink. Shanghai demand increased overall through the summer. That was different than last year. And I said that would happen. I said the interest in gold would increase this summer. You could have some price fades. I was a little bit wrong on that. It actually did go up. But the open interest is definitely a lot higher than it typically is. We didn't have our typical summer fade in the open interest. Now they also talk about COMEX net long positioning. I wanted to make a point here. In the World Gold Council, they talk about net longs. They don't talk about net shorts. They don't talk about the massive amount of shorts on the market. I guess you could say you could flip longs into shorts, but essentially you can see that there's more interest overall in net longs. That also means there's a corresponding net overall change in shorts as well. Here's supply and demand statistics for gold. It's used in jewelry, technology, and investors and central banks as money. You can see here that jewelry fabrication is a large part of the interest, 410.6 tons in Q2. Technology was 81.1 tons. That's things for main boards, electrical contacts, things that gold is used in. Straight investment from the public, 253.9 tons, and investment by the central banks, 183.4 tons. And of course, that led to an increase in the gold price because investment overall in demand is up. And for the end of 2023 and 2024, demand's been pretty solid. There's a good demand chart for you. Looking at average daily trading volumes, gold is second only to the S&P 500 in terms of different markets that they look at. They don't look at every market, but they look at the predominant ones across the world. You look at UK gilts, US corporates, German bunds, which are bonds, Dow Jones Industrial Average, the Euro Yen market, the Euro Sterling market. These are FX markets or currency markets. US T-bills are short-term treasury bills. Then you've got gold, which slightly beat the T-bills. More people are investing in the gold market than they are the short-term US treasuries. And then you have the S&P 500. The second largest trading volume of the major markets examined was gold. So again, indicating increased interest in gold. You see the trading volumes in August. If you look at the LBMA, which is a UK market, the non-LBMA trade data in the Shanghai, you had about $158.44 billion of interest in August, and that was up from 149 in July and 129 in June. Again, you can see that interest go up during the summer instead of down. Remember, when we look at open interest over time, it typically goes down in the summer or goes down or stays even, and then it went up this year. And again, that is in the latest data as we break open these markets into individual pieces. On the exchanges, COMEX did 50.21 billion. You can see that's clearly the biggest exchange in terms of gold derivative trading with physical mixed in. The next was Shanghai Futures Exchange, which I talk about all the time, at about half of that, 25.35. Notice that Shanghai is about half the size of COMEX now. That didn't always used to be the case. You can see back in the day, if you look at all of last year, it was about the third. Shanghai was about a third of the size of the COMEX. Now, in the last month, it's half the size. So what does that mean? Proportionately, more people are moving to the Shanghai to increase their gold positioning on that market than they are in COMEX relative to past periods and past years. Why? What have I told you about the Shanghai? It has more accurate pricing. It's more of a physically delivered market. We're moving from the COMEX to the Shanghai in terms of the amount of participation in gold, and that means the Shanghai market is rising, and it's clear in this data. As I've been talking about the last couple of 3 years, I've been really focusing on Shanghai, starting a report at the Silver Symposium about 3 years ago, where I said that JP Morgan was helping the Shanghai develop their commodities market, including gold and silver. And you can see it's about half of the volume of the COMEX, really, I think for the first time in history, or at least that I've seen it since I've been covering it. The Chinese market is rising as the COMEX is still a strong market, but it came down. Look at the numbers, 69.63 billion in July, now down to 50.21. People are exiting the COMEX into other markets. What did I tell you about all these numbers on the top line? You get the volume in OI. When you see these numbers go up, these off-market trades to avoid volatility and these EFPs to go to other markets, we're also seeing it in the trading data. People are moving off of COMEX to other markets. They believe the other markets are more democratized, have more physical delivery, have more accurate pricing. So you're seeing the gold trade shift from west to east, and it's clear in the data. When you look at ETFs, North America still is dominant at 2.38 billion. But if you look at the trade, the ETFs is only 1/25th of what you get on the COMEX. And overall, according to LBMA, it's 1/60th of what the LBMA is. So the LBMA and COMEX are still the dominant markets in terms of gold and silver, with the Shanghai rising. The ETFs, the retail demand here in the US, is not quite as strong as those markets. So gold is still primarily, the gold prices and the demand is still primarily determined by the big industrial exchanges, not the ETFs, but the ETFs are a prevalent measure of some retail demand. What it basically means is the US retail investor is not largely into gold right now. Most of gold goes to the big parties, the hedge funds, the bullion banks, the mines, the producers, and the US retail market is still not super strong and robust. In fact, if you look at Q2 of 2024, it was much more robust than it was in the summer. So the US retail demand has not returned. Now, ETF demand is a proxy for the physical, but when the ETF demand goes up, so too does the physical typically. And so again, the US retail is not demanding gold. A lot of people are saying they are. It's clear in the day that they aren't. Total liquidity for August, $241 billion. A nice, robust market for gold. Now going on to statistics for the central banks. I wanted to highlight what the central banks are doing in gold. Here's July's report. Reported net purchases by central banks more than doubled to 37 tons in July. The National Bank of Poland was a leading buyer in the month, followed by the Central Bank of Uzbekistan, the Reserve Bank of India. I'll break out India in the next tab and show you exactly what's going on there. A quote from the World Gold Council: central banks have shown an ongoing commitment to accumulating gold in recent months. While the overall level of reported demand has cooled as the gold prices continue to rally to new record highs, it has nonetheless remained positive. This commitment continued in July as global central banks are reported via the IMF and publicly available data to have added a net 37 ton to official reserves. That's not off-book buying. We know that China and Russia do off-book buying. I assume that India is doing as well. I'm assuming that a lot of the countries do off-book buying. Off-book buying, this is just the on-book, up 37 tons. And you can see a nice little tick up as we get to the end of summer. Again, summer didn't have that fade in terms of trade. It went up. It broke the trend in the COMEX. At the very end, in the ETFs, all the ETFs retail demand is down, but mostly in the industrial trade, the COMEX, the RBI, all that stuff we're going to see as we get into the fall, as we get into the increasing uncertainty geopolitically, the increasing uncertainty with the Chinese and US and two biggest economies. In the day that we see there, people are going into gold. You can see that clear trend. Other information here, if you guys want to go down and dive into central bank gold buying. But as you look, Turkey leads the way, India, Poland, China, Czech Republic, Qatar, Iraq. This is a nice little chart to show you there's been more net purchases in blue than there were in net sales. Let's make this a little bit bigger so you guys can see it. And that's about it for that report. On to India. This is RBI, India's gold market update. Import duty reduction, a catalyst for demand. So India had put some more import duties on gold to slow that gold import coming in. That led to an explosion of silver import. That was largely in part after India changed its currencies around. It wanted to limit the amount of gold in place to allow its currency to circulate and become the currency of the land. After that currency reset they did a while back, now they're reducing some import duties on gold, and it's leading to increased demand. Highlights from the article from 𝙁𝙍𝙀𝙀𝙀, research head for India. The reduction in gold's import duty brought domestic gold prices lower 6% month over month, with year-to-date gains now at 10%. The lower import duty has also reportedly boosted consumer demand ahead of the festive season. That's where they use gold in all their festivities, as well as weddings and things like that. In turn, strong demand pushed the domestic gold price to a premium relative to the landed price, following 5 months of discounts. The Reserve Bank of India continued with its consistent but measured approach to buying gold. So as we look overall at the LBMA and the domestic landed price, we're seeing the demanded domestic gold price dipped as international prices inched up, bringing them in line because they reduced the amount of duties and the global price went up, and that brought those two prices closer together, which means if you're in India, you're buying it closer to what the world buys it for because of the government reducing that higher import duty, which reduces the landed price when it gets to India versus what the rest of the world's paying. Makes sense why India is now increasing its purchases of gold, because the price is more in line with what everybody else is paying. Domestic gold prices shift from discount to a premium, so domestic gold prices have a little bit of premium on them now. An upsurge in flows of funds into gold ETFs, much like the ETF demand in the US has gone up slightly, signifying a little bit of retail investor interest. It's also happened in India, and you can see this chart, which I posted on X this morning. You can see a surge in July in gold ETF. Again, those import duties are causing people to want to buy more gold. And the Reserve Bank of India, the central bank, has continued its own purchases of gold, as you can see in this chart there. Gold ETFs holdings and flows. This is ETFs by region. You can see here, North America had strong ETF, 7 tons as of August. Europe had 4.4 tons. Asia dropped 3.7 tons, but they're going more physical, less ETF, more physical, as you can see in the statistics from the Shanghai Gold Exchange, which I showed you earlier. Other was about 0.3 tons around the world. So definitely an increase into ETFs. Retail segment around the world is starting to wake up just a tad. It's not fully going right now. It's not going bonkers, but you see people start to sector rotate out of investing in other things into now the gold ETFs. And that's usually an indication that the physical gold demand will increase. ETFs usually, when you have a rebound in ETF after a little bit of a year and a half of disinterest by the retail sector, it means that the physical inflows are coming. So I expect physical gold and silver buys in the US to ramp up in the third and fourth quarter. I think local coin dealers and the online shops are going to begin to see that. Gold ETFs holding by region, you can see that North America is the highest, Europe is the second highest, then you're followed by Asia and a little bit the rest of the world. The overall ETF holdings have fallen from 2021. Again, that was a post-shutdown world in which there was a surge in gold and silver demand. And when things kind of came back to normalcy, after the economies opened back up, the demand went down. But now the financial situation and geopolitical uncertainty is causing it to slightly curve back up. So we're not out of the woods economically, and people know that, and that's why the surge in demand for gold. Lastly, going into the AIC, that's the all-in sustaining cost. So this is more has to do with the mines and production sites. A flip from the finished product side, which we've been talking about for the last few minutes, and get to the mining side. This is supply. This is where it comes out of the ground. The average miner's all-in sustaining cost is like general administrative and cash flow costs and all the major costs that go into it, not only from the mining activity, but the activity of the corporation itself, marketing, general, selling, administrative, salaries, all that is wrapped into AISC. Now, AISC is not a perfect measure. Different companies kind of treat it differently, but it gives you the most consistent view of what it costs to get gold out of the ground, all in costs, the best that we can, given the current accounting practices. And you can see that all-in sustaining cost has been going up, starting with the shutdowns in 2020, which led to the increased demand, but they've been going up ever since. And that retail demand was down, Central bank demand was down, but overall physical gold demand was down, but the all-in sustaining cost went up. Why? It wasn't demand driven, it was inflation driven. Inflation has driven up the price. Now, I've shown you research from my friend at Gold Stock Data, Don Durrett, and I've shown you from SRS Rocco, Steve St. Angelo, about all-in sustaining cost being closer to 1,800 to 1,850, somewhere in that range, where the World Gold Council is telling us is slightly below 1,500. So they use a different methodology. So, and this is not a complete science. People use different methodologies. Don Durrett at Gold Stock Data analyzes about 500 gold and silver stocks and gives you through his research. Steve St. Angelo does a few less. He does the bigger producers, you know, by his own methodology, and he gives you a certain price. And then we have the World Gold Council, which is just what's been reported. So 3 different data sets, and they have different all-in sustaining costs for gold. But the key thing is it's getting more expensive to pull it out of the ground. That's raising the floor price for gold, because over time, the price for gold does not fall below the all-in sustaining cost to get it out of the ground for any length of time. People will simply stop production, stop supply, and it bounces off that line. So you can see part of the reason that gold has been rising has been the cost to get out of the ground. In other words, gold's tracking what? Inflation, because inflation is a part of what? Mining costs, and you can see that reflected here. So it's just another data point that you may want to look at. And here's an overall AISC curve, and you can see lately that curve, as gold production has gone up, so has the all-in sustaining costs. So costs are rising quickly in gold production, which means I don't expect its price to really fall down anytime soon. I think we're again in that bull market. Part of that's driven by inflation, which is reflected in gold price to get it out of the ground. But part of we started to see some of that retail demand reinvigorate gold's price as well. And that's why you're seeing increased gold prices. All right. Big report on gold. Now let's move into silver. A little bit shorter report, but a good one because we got some good data for you. Looking at silver, we've had a little bit of elevated interest in silver, which has allowed that price to rise, even though it's fallen down. It's now fallen back down well below 30. There has been a lot of interest. There were 131,000 contracts of open interest at close on Friday. Overall, the total volume was about half of that. Closed contracts about 63,585. Overall, EFP is 145. Now, these are 5,000 ounce silver versus 100 ounce on the average contract. So you'll have smaller numbers here in silver, but remember, there's more ounces per contract. So you got 145 contracts went over to the UK of 5,000 ounce silver. Deliveries are 3830. That is a large number, considering the fact that September wasn't a huge month. It only has 703 contracts left open. So the majority of contracts that were open were delivered at the beginning of September, meaning even though it's a small derivative contract trading month, people took whatever delivery they could get out of the system and they moved to UK to get delivery there. They've also, you can see the volatility go up in silver prices as well. So the clear ports, the block trades, and the trade after settlements are up as well. And that's people hunting for the metal. Settlement data, again, here's where the price is determined. It's on the derivative market. On Friday, we closed around 28,731 or 29,143 in the December contract, for about an 84-cent decline. On Thursday, we had about a 36-cent premium or an increase. And on Wednesday, we had about a 79 cent. So silver had been falling the last week, and that's primarily because of the positioning in the CFTC COT report, which I'm going to pull up here really quickly for you. And we're going to look over the COT report and see what happened to long and silver positioning in the market. Let me blow that up for you. So as we go down and we find silver, which is right here, here's the table for silver. Overall, 62,000 contracts short by the bullion banks. That's a speculative interest, 25,000 long. They're more than 2 to 1 short. And we know that they control the market because 8 or less traders short have 55.7% concentrated short. So 8 traders basically control the short positioning on the market. The 8 largest traders long only control a quarter of it. So the shorts have much greater control in a much smaller group, and it's mostly the swap dealers. Of course, you have the 38,000 position short by the producer merchants. Those are legitimate hedges. The managed money now is about 4 to 1 long, and the other reportables of smart individuals, family offices, are about 6.5 to 7 to 1 long. So we know who is shorting that silver price to bring it down. It is the bullion banks. Moving on to gold, if you look at gold on the COT report, again, heavy concentration of 8 or less traders, 59% of the short gold market, only 26% of the long. So again, the bullion banks, which you know from the OCC report, are the biggest shorters, are short gold, 306,000 contracts to 52,000 long, about a 6 to 1 ratio short to long. So that's what's keeping the gold price down. It's the bullion banks taking those short positions. Producer merchant, 79 to 10, about 8 to 1. That's to cover their legitimate hedging risk. But if you look at the managed money, which are the financial houses, they're up to 17,000 contracts to 17. That's about 11 to 12 to 1. And if you look at the other reportables, the family offices, rich individuals, they're up about 4 to 1 long on gold. So most of the market expects gold and silver to go long, but the bullion banks hold it down with their short positions for themselves and clients that they trade for, by the way. It's not just the bullion banks themselves. All right, on to the delivery notices. We're looking, if we go down, we're going to go find gold futures, COMEX 100 gold futures. And we're going to get to the bottom line. So this is gold futures. There we go. And this is as of the end of August. We're looking at deliveries. This is physical deliveries. You can see about 27 physical deliveries for August. August was not a big contract month, so you weren't going to get a lot. But you'll notice the pattern. Every other month's a big delivery month. 20,000, 30,000, 22,000. And it was bigger than the December of 2023, which is typically the biggest delivery month in gold and silver. So not only elevated interest in the metals, elevated deliveries on the large exchanges as well. Where they can get it and where they can't get it, they move, remember, through EFPs and other mechanisms to other markets. And because they can't get physical delivery, remember the report I showed you from the World Gold Council about how Shanghai in gold is about half of the volume in August that the COMEX was, for the first time that I've ever seen it. So again, people are moving east to the Shanghai as well. I think that even though the COMEX and the London market still dominate the gold and silver trade, you can see that changing. You can see this paradigm shift changing. All right, going down to silver, I get down basically to the end of the report for all intents and purposes for silver. Here's the silver futures, COMEX silver futures as of August 30th. And you can see robust deliveries in silver, 4,342 contracts. Even though September's not a big delivery month, you're not going to see a lot more deliveries because not many contracts left. They delivered what they could. And again, same pattern in silver. Every other month, big deliveries, 54, 61, 61, 43. And note that those are all higher than December, which is typically the biggest delivery month because it's the last month of the year. So again, silver as well, more deliveries on the COMEX, more open interest, more interest in the precious metals across the board in 2024. As I said, there would be, because it's a year of volatility in the economy, and you throw on the geopolitical uncertainty, which we'll talk about in another video, increased demand for the precious metals, a little bit of awakening at the end of the year for the retail sector, though it's been mostly the big boys participating. All right, good article I shared on X last week from Jason Hamlin at Talk Markets. I think originally I had quoted someone else on that, but here's the original article. And it says here, silver demand to soar with breakthrough of Samsung silver state solid battery. I'm just going to read the bullet points. You can go to Talk Markets and read the article if you want. Samsung's solid state batteries promise an impressive 600-mile range on a single charge and a lifespan of 20 years. If you actually wanted an EV or a hybrid to be super successful in the market, this is the kind of battery that you want. Because think about having a car with a 600-mile range in 20 years without having to worry about those batteries. That's almost equivalent to the longevity. In fact, it's better than the longevity of your typical gasoline car, although some will last longer than that. These batteries can charge in just 9 minutes, addressing one of the major hurdles in EV adoption. 9 minutes? You don't have to sit there and wait hours to charge your battery. This could really change things in terms of the ability for EV vehicles. However, there's a catch, and it has to do with silver supply. We'll get to that in a minute. With an energy density of 500 watt hours per kilogram, these batteries are nearly twice as dense as current mainstream EV batteries, allowing for longer travel distances in a smaller, lighter package. And the use of solid electrolyte instead of liquid reduces the risk of fires, making these batteries safer than traditional options. As we go down here, I'm trying to find the section where it talks about the overall demand and how it's going to affect silver supply. I saw it earlier today. Here we go. Now, if 20% of the global car production, which is approximately 16 million vehicles, adopts this new silver battery technology, the annual silver demand could reach 16,000 metric tons. Well, what the heck does that mean? Well, it would represent a significant portion, 64%, almost 2/3 of current global silver production, which is approximately 25,000 metric tons annually, highlighting the substantial impact on the silver market. If this new silver solid state battery technology gains traction and just 32% of global car production were to use it over time, that would require all of the current silver production. What does that mean? It likely means that if the EVs take off, whether current battery technology or especially this new one, it's going to suck all of silver demand up. That means more mines have to be ramped up. That means the overall prices in silver go where? Whoop, like that. They're going to go up super darn quick. Now, we're not going to switch over to EVs in 1 year. You're not going to see an explosion from a year of this happening. But over time, this is going to put tremendous pressure on mining supply. It's going to suck worldwide inventories out. That's before we even talk about silver as money investment demand, which is going to explode as we get into a recession. This is yet another huge catalyst for raising the overall demand for silver. We're not even talking about the demand of medical implements and technology in general. We're not talking about it for solar panels. We're just talking about cars. That of all these EV initiatives around the world, these green initiatives, get more electric vehicles on the road, and you're going to choose the best battery technology available. It's going to suck up silver even more going into the future than it does now with current battery technology. And people aren't going to want to buy the old EV cars because they don't have the range and the charging times that these do. So when these come out, they'll be more expensive. There'll be adoption rates, and they'll come down in price like all technology does. And when it reaches equilibrium with the other EVs, this technology is going to explode. So it may take 5 to 10, 15 years, but it's going to increase the demand on silver for sure. All right. Many of you may be looking at my hat today and wondering why I'm wearing a Make Silver Great Again hat. Make AG great again. This is not a MAGA hat political. This actually comes from one of the past sponsors of the program. Not a current sponsor, but somebody that I like. I went and visited their mine as Guanajuato Silver Company Limited. If you want to have more information on Guanajuato Silver, if you're into the mining stocks, go to gsilver.com. Look up their Cuban mine, which I toured, and I have a video on my channel from a couple of years ago that you can search. Just search Guanajuato, and you'll find that video where I did a little tour and I showed you everything about it. You guys may be interested in that. Just wanted to share that with you on the program. Make silver great again, indeed. And if this EV battery technology takes off, you're going to see much, much higher prices in silver. That's going to do it for today, guys. That's Rob with the Freedom Report. This is your gold and silver. Remember, we're going to break out the rest of it into shorter reports as we go throughout the week. That was sort of a mega gold and silver report. We'll try to keep the future ones to 15 minutes or less, but I thought I wanted to share that World Gold Council research with you. A lot of positivity, but to some, retail demand has not really recovered around the world. It's mostly central bank buying, which is starting to amp up again. It's mostly the big industrial exchanges. We're seeing signs that gold and silver are running out. We're seeing a shift from west to east in terms of the exchanges that are doing more and more of the trade, and that's slowly happening. And we're starting to see retail around the world start to wake up a little bit in gold as we get deeper into what I think is a recession, and also the geopolitical risk, which we'll talk about in future videos. That is your precious metals report for this week. Once again, Rob with the Freedom Report. Until next time.